Righto, New York City, October 22nd, 7 minutes past 7 in the evening. There's a queue snaking 3 blocks down Broadway from the Knickerbocker Trust Company's doors. Inside, the tellers are dishing out the dough as quick as they can tally it up. $8 million will be out of the vault in 3 hours. Then they'll shut up shop. New York's third biggest trust company is completely cactus. Later that arvo, the price of borrowing a quid on Wall Street skyrockets to 70%. Just 2 days on, it'll hit 100%. Not over a year, mind you, but in a single day. Investors who've borrowed big are flogging off anything they can get their hands on. Shares, bonds, anything easily convertible to cash before they go belly up. Assets backed by gold get chucked out with the bathwater. Not 'cause gold's no good, but 'cause it's the simplest thing to offload when everyone's panicking. All right, imagine this. September 15th, 2008. Lehman Brothers goes bust. Gold's reached a record high, over $1,000 an ounce. Just half a year prior, in a matter of weeks, it'll plummet almost 30% down to $712. Hedge funds stuck with mortgage-backed securities they can't shift are offloading gold, the only asset they can flog to cover their margin calls. Right then, picture this. March 16th, 2020. COVID's brought the whole world to a standstill. Gold takes a tumble, dropping 12% in just 1 week. The World Gold Council puts out a report the very next day. The heading pretty much sums it up. Huge sell-off across nearly every type of asset. Then come March 2026, gold plunges 12% in just 1 month, the roughest month it's seen in 13 years. The World Gold Council names its official yarn with 5 words this channel's been spruiking for ages. Flog what you can, not what you fancy. It's the same old story, same way it works, same result, without fail, every bloody time. Here's the bit that really gets me thinking when I can't sleep. Every one of those mad panic sales was always followed by gold reaching a brand new record high. Everyone, well, most folks, ended up selling at the absolute lowest point because they mixed up a cash flow crunch with a gold problem. By the end of this video, you'll know exactly what happened in each of these 4 situations, who sold up, why they did, and what gold got up to afterwards. And you'll get your head around a pattern that's been doing the rounds for more than 100 years. Hang in there with me. Before we get stuck into it, this is just a bit of history, not financial advice, mind you. Do your own digging, mate. This whole setup works in 3 steps. First up, leverage starts building. Funds borrow to pump up their returns. Next up, a shock hits, and losses just tumble through your liquid asset. Finally, funds flog off their most liquid assets to rustle up some cash. Gold's easy to shift. It gets sold not 'cause it's a dud, but 'cause it's solid. Someone's always keen to snap it up. 1907. 2008, 2020, 2006. Same 3 steps, same result. First cab off the rank. The big panic of 1907. Here's the thing most folks miss about this whole shebang. It had absolutely nothing to do with gold. It all kicked off with a stock market fiddle that went pear-shaped. A mining bloke, F. Augustus Hines, and his brother Otto had a crack at cornering United Copper Company shares on the 14th of October. They pushed the stock from $39 to $52 in just 1 day. The corner went belly up the next morning when short sellers managed to rustle up shares to hand over. United Copper went belly up, and because Heinz was tied to a whole bunch of banks and trust companies, the trouble just spread like wildfire. The Knickerbocker Trust Company, which this bloke Charles T. Barney was running, had a few personal mateship connections to Heinz. Come October 21st, the National Bank of Commerce let everyone know they'd be knocking off clearing for Knickerbocker. First thing, the next morning, the panic started. J.P. Morgan, the actual fella himself, not the bank we know now, had rocked up back home a couple of days before, after an Episcopal shindig. He sent off a young examiner, Benjamin Strong, to have a squiz at Knickerbocker's books through the night. Strong. He'd later end up being the very first boss of the New York Federal Reserve. Morgan managed to pull together about $30 million from private pockets. John D. Rockefeller chucked in $10 million himself. The Treasury Secretary, George Cortelyou, plonked $25 million of government cash into the banking system. The call money rate, which is what brokers paid to borrow a bit of dough, shot up to 100%. So if you'd borrowed coin to keep your positions, you were forking out the whole value of your position in interest, day in, day out. What's a bloke to do? You flog off anything you can get your hands on. Stocks took a dive, dropping almost 50% from their highest point. Charles Barney, the Knickerbocker boss, topped himself on November 14th, after Morgan wouldn't even give him a good day. Gold itself wasn't copping any flack. Under the gold standard, gold was the actual money. But anything backed by gold, stocks, bonds, trusts, got flogged off for peanuts because those leveraged investors were desperate for a bit of cash. The whole shebang. That led straight to them setting up the Federal Reserve in 1913. The big lesson no one cottoned onto was that it's leverage that does you in, not the asset itself, just the leverage. And here's the second example that shows it wasn't just a one-off. Number 2, the 2008 crash. Gold shot up to a brand new record of $1,011 on March 17, 2008. That was the same day Bear Stearns got bailed out, eh? Then, half a year later, Lehman Brothers went belly up. And then, get this. Something went down that still stumps people. Gold took a massive dive, nearly 30%, from over $1,000 right down to $712 by the 24th of October. How's that even possible, mate? Gold's meant to shoot up when things go pear-shaped, and it does, eventually. But first, everyone bails out of it. See, hedge funds were stuck with these dodgy mortgage-backed securities that no one would touch. So they had to flog off something else to cover their margin calls from the big brokers. Gold was easy to shift, there was a tidy profit in it, and you could offload it in a flash. Even Lehman Brothers themselves got rid of their precious metals holdings. The gold forward rate went a bit wonky when the bullion banks started reining in their exposure to other parties. The whole shebang was exactly the same as back in 1907, just with different financial tools and much larger figures. And get this, gold actually wrapped up 2008 with a positive yearly return, one of the very few assets that managed it. It bounced back over $1,000 by mid-2009, and by August 2023, it was sitting at $1,917, a whopping 163% jump from its lowest point during the crisis. In just 3 years, those who chucked their gold in a panic at $712 had actually offloaded the best-performing asset in their whole kit and caboodle. Folks who snapped it up at $712, well, they ended up tripling their dough. Just a quick sec. If you're beginning to cotton on that, those big headlines yelling about gold taking a nosedive are actually the absolute best signals to buy in, ever. Give that subscribe button a good whack. You're listening to the independent financial historian here. I'll show you the post-mortem so you can spot the trends before they do their thing again. Righto, number 3. The big COVID sell-off in March 2020. This particular one all went down in just 12 days. Gold was hovering around $1,680 back in early March of 2020. By the 16th of March, it had taken a bit of a dive, about 12%, landing at $1,470. Everything copped a hiding. Shares, bonds, even those US treasuries. Even the asset everyone reckoned was the safest on the planet dropped in value, even though the Fed slashed rates by an emergency 1% on the 15th of March. When everyone's scrambling for a bit of cash, there's nowhere safe to hide. It's just about the folding stuff. The World Gold Council actually tracked how it all went down as it happened. Gold changes hands for more than $260 billion every single day. And that's exactly why it gets flogged off when there's a liquidity crunch. It's the most easily traded market after US treasuries. And on the 15th of March, even those treasuries were getting offloaded. Gold was the next easiest thing to shift, so it was the next to go. Those risk parity funds, you know, the ones that automatically juggle between shares, bonds, and commodities. They were chucking gold because their volatility models were yelling, "Sell!" CTAs, commodity trading advisors, those funds run by computers, hit their stop-loss points and set off a whole chain of sell orders. In just 5 months, gold shot up to a brand new record high, hitting $2,072 on the 7th of August 2020. That's a 41% jump from its March low. That was the quickest bounce back we'd seen in any of these sorts of events. The same old story played out again. Big institutions with a lot of debt flogged off gold to get their hands on some dough. Once the forced selling stops, gold bounces back to new peaks. The only real question is if you're going to freak out with the big players or snap up what they're offloading. Number 4. The correction from January right through to March 2026. Gold reached $5,595 on the 29th of January 2026, the highest price ever recorded. The very next day, it plunged over 13% across 2 trading periods, marking the sharpest one-day fall since way back in 1983. Silver took a massive tumble, dropping 34% in just one day. This time around, the main trigger was Kevin Warsh getting the nod, seen as the most hard-line bloke to take over from Jerome Powell as the Fed chair. Then Operation Epic Fury kicked off on the 28th of February, that US and Israeli air attack on Iran, and oil prices shot up past $100 a barrel. Interest rate predictions changed tack. Margin calls just kept on coming. Just in March, North American gold ETFs lost a fair chunk, like $13 to $14 billion. A whopping 87 tons of gold bailed out of those funds. The managed money holdings on the COMEX went down by 22 tons that month, with the biggest weekly dive being around 40 tons in the third week. Those computer-run funds just dumped their holdings the second gold dipped under its 50-day moving average on March 16th, which hadn't happened for 7 months. The Bank for International Settlements put out a special report showing that it was the everyday punters, not the big institutions, who were behind that earlier rush of money coming in. Liquidations sparked by margin calls just created a never-ending cycle. Everyone was offloading their stuff because everyone else was doing the same. And the World Gold Council, who are pretty much the top dogs in the gold market, kicked off their official March commentary with some words. You should really etch this into every investor's brain. Flog what you're able to, not what you'd prefer to. But get a load of what went down on the other side of the globe. While North America was in a mad rush to sell, Asian gold ETFs, with China leading the charge, actually pulled in $2 billion that very same month. So, while the Western funds offloaded 87 tons, the Eastern ones just soaked up all that selling. And by early April, global ETF flows were back in the black, with 21 tons rolling back in during the first week of the month. Goldman Sachs, those blokes who famously reckoned gold was a dead-set goner back in 2013 at $1,000, are now tipping it to hit $5,400. JP Morgan's predicting 6,300. Deutsche Bank saying 6,000. Societe Generale, who chucked out a report called The End of the Gold Era in 2013, now reckons $6,000 is a pretty conservative estimate. The very same banks that told you to offload it at $1,000 are now telling you to hang on to it at 4,700. That's not a stuff-up. That's just how they roll. They flog it when it's at its lowest and snap it up when it's at its peak. Then they tell you to follow suit. What actually tanks? It's leveraged gold positions that go belly up, not the gold itself, but the leverage. Every single one of these 4 times, folks who held gold on margin got absolutely wiped out. A margin call, mate. It couldn't give a stuff about your big ideas or the basic facts. It's all about the dosh. No cash in the bank? Your position gets wiped out, fair dinkum. Folks who actually hold physical gold, the real stuff, not just a bit of paper, they've never been completely cleaned out during a cash crunch. Sure, their gold might have dipped a bit in value for a while, but no one ever made them sell it off. And without fail, every single time, the price bounced back even higher than it was previously. Right now, the warning bells are ringing, and we've just gone through what feels like episode 4 of it all. The market correction, that little tumble, it all went down between January and March this year. Gold took a dive from $5,500 right down to about $4,100. It's already on the mend, mate. Trading above 4,700 as I'm yapping on here. The Yanks just slapped a naval blockade on the Strait of Hormuz, because those peace talks with Iran went belly up over the weekend. Oil's nudging $100 a barrel. The Fed's in a real pickle, caught between rising prices and a government that can't stump up for bigger interest bills. Central banks are hoovering up gold quicker than they have since way back in 1950. And those managed money positions that just got flogged off? They haven't been put back together yet. History tells us what's next, mate. The debt gets sorted, the panic settles down, the real reasons for value kick back in, and gold always shoots up higher than it was before. It's not because gold's got some magic powers, but because the stuff that pushed its price up, like deficits, printing heaps of cash, global dramas, and big institutions not trusting the dollar, didn't just vanish during the crash. They actually got a fair bit worse. The real question is whether you'll spot the pattern or just end up being part of the problem. Remember Charles Barney? He topped himself back in 1907 after a crisis that had absolutely nothing to do with gold. Poor bloke. Lehman Brothers went bust in '08. And those gold owners who flogged their stash at $700 were kicking themselves for 10 years. And the blokes who panicked and sold up in March 2020, well, they missed out on a massive 41% surge in just 5 months. It's the same old story every time the leverage snaps, mate. They flog off the liquid asset and the patient punter who held on gets a decent reward. It's all worked out mathematically, mate, so the outcome's a dead cert. The only thing that's up in the air now is you, mate. Go on, grab something real before you're stuck flogging off something fake.